Okay, get this. Imagine a company borrowing billions of dollars, not to build a factory or hire people, but to buy an asset that produces zero cash flow. It sounds absolutely insane, right? Well, it's happening. A small but very loud group of public companies are swapping out their cash reserves for Bitcoin. So let's dive into this incredibly bold and, you could say, incredibly risky financial experiment. Here's what we're going to cover. First, we'll get our heads around what this new frontier even is. Then, we'll look at the key players and the playbooks they're running. From there, we'll stare right into the abyss and talk about the huge risks. Then, we'll see if history has any clues for us. And finally, we'll ask the big one. What does this all mean for the future of finance?
All right, so what is actually going on here? We are literally watching the birth of a brand new corporate strategy, one that completely rethinks the whole point of a company's treasury.
And this really gets to the heart of it, right? This is the central question that frames our entire discussion. Why on earth would a rational company take on debt to buy something as famously volatile and non-yielding as Bitcoin? It just seems to fly in the face of all traditional financial logic.
And here's the key distinction we have to make. We're not just talking about a company buying a little Bitcoin to hedge against inflation. No, the source material calls this structured speculation. It's an offensive move. These companies are actively borrowing fiat, regular government money, to make a massive, long-term leveraged bet that Bitcoin's price is going way up. They're treating it less like digital property and more like a whole new form of digital capital.
So let's move on and see who's actually doing this. Who are these pioneers? Or maybe madmen? And more importantly, how are they getting the cash to fund these gigantic purchases? The scale of this is pretty staggering. I mean, sure, governments and private companies are in the game, but it's the publicly traded companies that are really leading the charge here. They hold over 71% of the Bitcoin on corporate and government balance sheets. Think about that. They're doing this right out in the open with their shareholders' money on the line. And when you look at the players, one name just towers over everyone else. Strategy Incorporated, which you might remember as MicroStrategy, is in a completely different league. They're holding over 628,000 Bitcoin. They are the benchmark. They're the ones who literally wrote the playbook that everyone else is now trying to copy. But don't sleep on the private companies, because they've got some heavy hitters too. Block One and Tether Holdings are major players. And Tether's position is really interesting, right? Because they issue the USDT stablecoin. They're kind of at the center of the whole crypto ecosystem. Oh, and yeah, that's Elon Musk's SpaceX on the list too. So where is all this money coming from? Well, it pretty much boils down to these three methods. Some companies, like Strategy, use convertible bonds. It's a pretty clever way to get cheap debt. Others just issue and sell brand new shares of their own stock. And then a few, mostly the crypto-native companies, are just using the cash they make from their actual business. But believe me, each one of these methods comes with its own scary set of risks. And that brings us to the most critical part of this whole explainer, the sheer fragility of this strategy. This isn't just risky, it's a financial high-wire act, and there is absolutely no safety net. This is the question that cuts right to the bone. It exposes the core risk of the whole thing. If you take away all the Bitcoin, is there a healthy, cash-generating business left underneath? Or is the company just a hollowed-out shell, a vehicle whose entire existence depends on the price of a single, ridiculously volatile asset? The difference here is just stark. A healthy business uses Bitcoin as one piece of a much larger strategy. But a hollowed-out one, well, it is the Bitcoin bet. And the source material is pretty clear that most of these companies, frankly, fall into that second category. They have unprofitable core operations that simply cannot survive unless the price of Bitcoin keeps going up. And this is where that risk becomes terrifyingly real. For a company like Tesla, Bitcoin is a rounding error, less than 1% of their assets. But for Marathon Digital, it's 78%. And then you have Strategy Inc. at an unbelievable 135%. And no, that's not a typo. Their Bitcoin is worth more than everything else the company owns combined. So what happens if the crypto market tanks? Well, they enter what the source calls the panic zone, and they're staring at three truly terrible options. 1, they can sell a ton more stock,
which just crushes their existing shareholders. 2, they can sell their Bitcoin, which is basically admitting the entire strategy was a failure. Or 3, they can just hold on tight and pray for the market to turn around. None of those are good choices.
And look, the risks aren't just internal. The entire model is incredibly vulnerable to big shifts in the wider economy. If interest rates go up, their debt gets way more expensive. If the Bitcoin price just goes sideways for a few years, investor conviction could just evaporate. And a regulatory crackdown, that could create a massive stress test for their balance sheets overnight.
Okay, now as completely wild as this all seems, the basic idea behind it isn't entirely new. If we look back, we can actually find some historical parallels that help us understand the playbook these companies are trying to run. For centuries, wealthy families have built fortunes by doing one thing: borrowing cheap money to buy up scarce land. The Bitcoin playbook follows that exact same logic. You've got a scarce asset, cheap capital, and a long-term hold. But, and this is a huge but, there's one crucial difference. Land produces yield. You get rent, you get crops, you get resources. Bitcoin, at least for now, does not. So you might be wondering, okay, well, why didn't companies ever do this with gold? Good question. Gold just has too many limitations. It actually costs you money to store it securely, it's a huge pain to move around, and it's really hard to use as collateral in a modern financial system. Bitcoin's digital nature just completely changes the game. It can be sent anywhere in the world in seconds and plugged directly into the world of digital finance in a way that gold just never could. All right, for our last section, let's zoom all the way out. What does this whole trend really mean for the financial system as a whole? Because the ripple effects here are way, way bigger than just a few company balance sheets.
For Bitcoin itself, it's a classic double-edged sword. On one hand, this strategy creates a whole new class of long-term buyers, which really strengthens that digital gold story. But on the other hand, it introduces a massive new risk. If these companies get into trouble, they could become forced sellers, which would make any market crash way worse. And if a major player goes bust, the damage to the institutional narrative could be huge. This is fundamentally changing the job description for a corporate finance team. All of a sudden, CFOs and the risk officers have to figure out how to manage a completely new and incredibly volatile asset class. You can bet the conversations happening in boardrooms all over the world are changing. They're now forced to have an opinion on Bitcoin. And this is where it gets really, really interesting. The line between crypto and Wall Street is getting blurrier by the day. The stock prices of these companies now basically trade like leveraged ETFs for Bitcoin. The bond markets are starting to price crypto volatility into corporate debt. And regulators, they're scrambling to catch up. For better or for worse, Bitcoin is entering the bloodstream of the traditional capital markets. So here's the bottom line. For this whole strategy to actually work in the long run, Bitcoin itself has to evolve. It can't just be a speculative digital pet rock sitting idle on a balance sheet. It needs to become productive. It has to start doing something. Which brings us to the ultimate question, doesn't it? Are we watching the birth of a revolutionary new asset class, real, true digital capital? Or is this all just one massive leveraged illusion that's destined to become a very violent footnote in the history of corporate finance? Only time is going to tell.